Welcome back to Yuri's Box. In this video, I'm going to talk about the flaws of data dependence and forward guidance. If you enjoy this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So this video is really catered more towards people that have some experience in the investment world. Say you've just started, dabbling in stocks, and maybe you've looked at some bonds and you've just watched some Bloomberg in your free time, and you start to realize, bond prices go up as the yield goes down, and vice versa, and you're starting to get a little bit more curious about these things. And I'm sure that in this stage, you kind of struggle. If I know that I struggled a lot to kind of put one big actor in all of this in and make it fit in the right box. And I'm referring to the Federal Reserve. Because when you're starting out, especially, you have all of this data, kind of coming at you in different directions. And you have the Wizard of Oz basically coming out once a month, well, at certain intervals, of course, in the shape of Pal, and talking and saying things. And then you have, these little minions, let's call them, coming out and talking and saying a lot of things with, where we are in the business cycle. Minions being the members of the Federal Reserve Committee. And it's really tough, I think, or at least it was tough for me to kind of figure out, how do I treat these guys? How do I interpret what they're telling me? Should I take it seriously? Should I completely ignore it? What do I do with what they're telling me? And to kind of square everything, I want you to imagine being part of a business, okay? And you start off with a small business. Now, what's the biggest advantage of being a small business? Flexibility and proactivity, being proactive, meaning that rather than just waiting for things to whack you in the face, you're constantly looking into the future and asking yourself, what can hurt me? What can hurt the business? And how can I prepare in a way that if something bad happens, not only will I be ready, but it'll also be kind of like an opportunity to expand the business and make the business better, okay? But as time goes by, something changes in the nature of business XYZ, let's call it. Rather than being proactive, it spends more time being reactive and trying to just make things chug along. And rather, again, than being proactive and looking into the future and trying to say, what can hurt us? How can we best prepare, to take advantage of whatever comes in our way? It's more of I'm busy making sure that everything I did up until now has continuity into the future, okay? And if something comes up, I'll react to it. I'm not going to wrap my head around, 1,000 different scenarios. Again, I'm just going to react to it, whatever comes my way. And that is one of the reasons why it's really hard for a big business to be on the cutting edge of expansion, because you just have so many things to worry about. Okay, now how do I bring that back to the Federal Reserve? Well, the Federal Reserve is, if you have to think about it, is it more like a small business or a big business? It's the biggest business you can imagine, okay? And not only that, it's even worse because it's a public institution. It's a public business, okay? So it has even more problems. And to show you how they are reactive in nature, And this is something else that you'll often hear the talking heads on Bloomberg and a lot of business news. And I'm not in any way talking down to these. I love Bloomberg. You know, I love listening to Bloomberg. I'll listen to it every day. Um, but you often hear people argue that right now the Fed should have um, a better way of looking into the future and where we are, because as of right now, what the Fed is doing is nothing more than, again, reacting, and they treat this feature as a bug and not really as a feature um, of the Federal Reserve, because the Fed, in my opinion, was, is, and will likely continue to be reactive in nature. Okay, and to show you this, I'm gonna show you, give you an example, and I'm gonna show you the Fed's own words to prove what I'm telling you. So, if you're familiar with what the Federal Reserve does, so they have meetings throughout the year, and 4 times a year, in March, June, September, and December, they'll release a document that's called the Summary of Economic Projections. And what they do in this document is basically their best guess. What they say is, this is where we are right now, and if where we are right now continues into the future, this is where we'll be in a year's time, 2 years' time, and etc., etc. So let's take a look at, first of all, let's take a step back to December of 2023. Okay. Now, inflation in 2023 was still really a hot topic because we came off of, kind of like now really, but anyway, we came off of this huge surge in inflation in 2022. We had a disinflationary process playing out, but it kind of stalled out around 3% in June of 2023, and by December of 2023 it was about 3.4. Now, at that point, the Federal Reserve had already hiked to 5.5. And in October is when actually Powell came out and he said, you know what, we hiked a lot. Yeah, inflation kind of ticked up a little bit, but honestly, we still believe that the disinflationary trend will eventually get back on track. And so we see no reason to hike rates, to think about hiking rates. And if it does continue to play out, in 2024, we'll likely be able to start thinking about easing policy. Okay? So this here is the dot plot. Now, what is the dot plot? In this chart, each dot is basically where each member of the Federal Committee, each member of the Federal Reserve sees interest rate policy being at the end of that year. Okay, so of course it's December, so everybody was telling you that we're not going to move for 5.5, but in 2024 they started to indicate that, you know what, will likely be anywhere between 4.5% and 5%. That's a fair deal of cuts. Okay. Same thing for 2025, where a majority was saying somewhere between, this is putting every dot together, somewhere between 3 and 4%. Okay. So again, each dot represents basically where a member of the Federal Reserve is telling you that he or she thinks interest rate policy will be at the end for that year. Okay. What happens after this, after December of 2023? Well, definitely not oil. After December of 2023, the opposite kind of happens. You have upside surprises in inflation. You have inflation going up from December. You have it going up to 3.5. Okay, this was definitely the opposite of what they were hoping for, because in order to recalibrate interest rates, you really have to have inflation playing ball, apart from the labor market falling aside. The labor market was fine, but inflation really wasn't playing ball at that point. So, what did they say 3 months later? 3 months later, this is what the picture looked like, okay? So, go back to December. In December, let's just take a look at 2024. Most members were saying somewhere between 4.25% and 5%. That's where the majority of members were. In March, 3 months later, for end of 2024, you can see the dots starting to move up. So what they're telling you is, yeah, all those rate cuts we talked about in December, kind of not going to happen, because inflation is still a problem. At best, we're going to be between 4.5% and 5%. Okay, so you're starting to move it up a bit. For 2025, what they're saying is, again, as we said before, somewhere between 3 and 4%. Here as well, you start seeing the dots start to move up. And what they're basically telling you, again, as a general picture, somewhere we envision being collectively, again, we envision interest rate policy to be around 3.5% and 4%. That's what they're telling you. What happens next? This is March of 2024, so 3.5. We get to June, time for the next summary of economic projections, and we have inflation back at 3%. Now you might say, yeah, okay, great, inflation's been going down, great news, but if you kind of just take everything away from that point on, this is where we were. Now, if you look at this, I mean, you might be optimistic and say, yeah, it's going down. But if you kind of look at the bigger picture, you might argue, well, we were here a year ago. We made absolutely no progress on inflation. Inflation is still moving up at the same rate it was a year ago. And that's kind of what they went for. Because if you look at what they were saying in June 2024, in June 2024's dot plot, it's exactly that. Focus on 2024. This is March. Okay, so 4 to 5%. Now you have basically everyone saying, at best, we're going to have one rate cut. One, maybe two. So majority is saying somewhere between 5 and 5.5. That's basically where they were. They were interest rate policy peaked out between 5.25, 5.25, and 5.5. That's what they're telling you. There isn't any more room to cut given where inflation is. Focus on 2025. This is the summary of economic projections for March of 2024, what they were indicating back then. And as you can see, the dots just keep moving higher and higher because, we'll still be able to cut in 2025, but, given where inflation is right now, we can't do it, man. It's too tough, too much. Let's go back to inflation. If you recall, after June, you have July, August, and September. And you have 3 months of, at times, weak economic data, especially in the non-farm payrolls data for July. where you see the unemployment rate peak out at 4.3, and the unemployment rate really had steadily been going up ever since March by a tenth of a percent per month, and it peaked out actually in August. And this was really a big deal because usually when the unemployment rate starts to go up at, at this angle of attack, it doesn't usually stop. It's that kind of non-linear progression in the unemployment rate that really gets people scared. We also had the SARM rule trigger, which is another uh, recessionary indicator. So overall, the summer wasn't really looking that good because you had economic data pointing downwards, and you had peak economic pessimism, and you had the inflation rate actually begin to move significantly lower, significantly low. It actually bottomed out at 2.4% in September. Okay. Given all of this, what do you think the Federal Reserve did next? This is the summary of economic projections for September. And focus again on where the dots are in 2024. Let's look at where they were in June. And as you can see, the dots are starting to move significantly lower, meaning we're going to cut, and we're going to cut by at least 100 basis points this year. And as far as 2025 is concerned, this is June. What they're saying now in September is that a lot of the members were looking at between 3 and 3.5. And keep in mind, at this point, they were still at 5.5, if I'm not mistaken, or they had just cut by 50 basis points. So we're talking about between 200 and 250 basis points, depending on when what your time frame is, of rate cuts throughout 2024 and 2025. And again, why? Because data just started looking kind of sour. You had good progress on disinflation, but it was kind of the wrong type of disinflation because it was coming at the cost of an increased unemployment rate and lower jobs being added, and the non-farm payrolls number came out pretty weak. So it wasn't really looking that good. And this is how they reacted. They basically just said, you know what? Forget the hawkishness we showed you in June. Forget about all of that. This is what we're going to do from now on. But of course, from that point on, inflation bottomed out and it started its uptrend. It's still currently on. The unemployment rate actually started going sideways with a downward bias. You had economic data starting to look much better. And sure enough, in December's summary of economic projections, this is how the dot plot looked like. Okay, so they kept on cutting, granted, but for 2025, surprise, surprise, the dots started moving back up again. And why is that? Because now, and again, the curious thing is that they were basically indicating the same thing they were indicating in June. Okay, if you just skipped September, you'd say, you know what, this looks kind of, it doesn't really look very contradictory. Apart from the fact that if you put September back in, it just looks totally contradictory, as if they were going blind. And just to tie things up, this is where we are now. We have unemployment rate being where it is now at 4%. You have inflation kind of being a problem. So we have the Fed going off of peak inflation fears and the bottom probably of growth fears, and they're telling you we're not really going to cut that much in 2025. Now, why did I show you all of this? To tell you two important lessons that I personally think are very valuable, especially for people that are kind of at the beginning of their investment journey when it comes to how to really treat the Federal Reserve. And what I have in front of you is one of the last articles I wrote for my site. And if you like it, you can read the entire article. But again, what are the two good lessons you should learn from all of this? Is that rather than actually being a source of stability and generally making things easier to read, everything they say, just the Federal Reserve says, has the opposite effect. Okay, it kind of makes things even more unstable because everybody is looking at them for their interpretation of things, but their interpretation of things is based off of something that's already happened. Okay, it's again data dependent. What does data dependent mean? It means waiting for the past to give you answers and tell you what to do next. But if you're waiting for the past to tell you what to do, it's already past. The past is telling you probably where you should have been in the past, not in the present. And if anything, if you really wanted to listen to what the people on the Federal Reserve have to say, I'd argue that the best way of treating their words is as, simply put, a contrarian indicator. What are they worried the most about now? Is what they'll likely be. If they're worried about one thing right now, they'll be worried about the opposite in 6 months' time. So if they're worried about inflation right now, chances are that in 6 months they'll be worried about the exact opposite. And if they're worried about growth right now, in 6 months' time, they'll likely be worried about the exact opposite. And second of all, which is probably the most profound consequence, is that rather than taking them seriously during normal times, you should take them seriously in abnormal times. Imagine that we're talking about a person, okay? A person you've known for 20, 25 years, okay? If you had to talk about them to someone, you'd say, I've known them for 25 years. They've been a pretty okay person, and they've had their moments of panic, but I'm not going to judge them based off of that. It's just a smidge, nothing to worry about. But because they have coming back to the Federal Reserve, because they have this data dependent approach, but they're basically waiting for the past to tell them what to do. What they say right now is completely unreliable. And what they say, and by right now, what I mean is normal times, when things are just chugging along. Again, you should treat what they're saying at best as a contrarian indicator, if you really want to look at them. However, because a data-dependent approach means that you're going to be late, as the dot plot shows you, because they're basically reacting to something that's already happened. And if you're reacting to something that's already happened, that's the definition of being late. The only times that you should take them seriously is during the extremes. And what do I mean by that? Let's look at the Fed funds rate. Extreme cases are here it is, yeah. This in 2008, or 2022 when they had to hike rates at an incredibly fast rate. You should take them at face value. You should take their words at face value when they're panicking. That is when they're realizing that they're really late. Okay? Because at that point, you know that they're going to do something that's pretty significant. Apart from that, as long as things are stable, you should completely ignore them. And if you really, really, really want to listen to them because you have a passion for this sort of stuff, at best, they're a contrarian indicator. Okay? So hopefully I did a good job of explaining where I stand on this issue. And I'll leave it at that. So if you liked it, consider leaving a like, and I'll see you next time. Bye.